Hi, I'm Melissa Roberts, a managing director at Stephens, leading coverage of strategic opportunities and index rebalancing research. The Russell Index Reconstitution occurred at the end of June, and there are two interesting, if not surprising, performance trends for new adds to the Russell 2000 index. This is especially true of banks added to the index. The first is that historically Russell 2000 new adds performed wrong way, and that means they underperformed from the publication of the first list of recon changes through Reconstitution Eve, and they continue to lag mostly through year end. The second is that conversely, banks added to the Russell 2000 index had unique post-Recon price performance trends, and they historically outperformed from Recon through year end. So that begs the question, why do banks outperform while other industries lag? Consider that nearly $11 trillion in benchmarked assets track the Russell indexes, with nearly $2 trillion invested in passive funds tracking the Russell US index family. Hence, there is significant demand for shares of new adds to the Russell indexes. Given the Russell 2000 index covers the less liquid, smaller cap universe, and this demand for shares occurs in a well-defined time period, index inclusion can meaningfully impact both the price and the trading volume of new adds. All else equal, outsized demand from shares from passive funds should support positive price momentum and drive volumes higher. We see this in the pre-recon price performance in all of the last 17 recons, from as early as the end of October prior to the recon year through the April rank day. Russell 2000 new adds outperformed consistently by 59% on average. But surprisingly, once the list of recon changes is announced, this outperformance has not broadly continued for new adds over the last decade. So, what could complicate this and ebb away potential positive returns? Well, the answer is the participation of actively managed investors who attempt to capitalize on the liquidity event for Russell 2000 new adds and provide shares to the passive funds. If their participation or excess supply of shares overwhelms passive demand for shares, the new adds could perform wrong way and underperform. Historically, once the first list of recon changes is published, Russell 2000 new adds lagged, likely driven also in part by short interest pressures from recon trade facilitation hedging. Short interest surges for new Russell 2000 adds, largely due to hedges associated with facilitating recon trades for the passive funds. In the most recent recon in 2025, short interest rose by a median 183% from the April 30th rank day through June for Russell 2000 new adds, and a more outsized median 423% for the Russell 2000 new bank adds. Consequently, over the period from the first list's release through Recon Eve, Russell 2000 new adds underperformed in 7 of the last 10 recons. In the 2025 recon, the Russell 2000 new adds lagged by 8% over this period, with outsized underperformance for Russell 2000 new bank adds, which trailed by 13%. 2025 marked the worst performance of Russell 2000 new bank adds over this period in the last decade. But Recon Day is when the performance similarities between the Russell 2000 new adds and the bank new adds end. The Russell 2000 new adds lagged from Recon Day to year end in all of the last 10 recons, and that's likely due to the fact that the index does not have any profitability criteria for inclusion, resulting in a number of new adds that ultimately delist and drag down post-recon price performance trends. Banks are regulated and somewhat more immune from failure risk. As a result, The Russell 2000 new bank ads saw atypical historical post-Recon performance trends, and they mostly outperformed both the market and bank peers. From Recon through year-end, the Russell 2000 new bank ads outperformed the market in all last 10 Recons, save during the global pandemic in 2020. This likely reflects increased institutional investor visibility and that banks are mostly immune from profitability-driven post-Recon underperformance. Russell 2000 new bank ads also largely outperformed their banking peers. In 7 of the last 10 Recons, Russell 2000 new bank ads outperformed the KBW NASDAQ Regional Banking Index. This broad outperformance of bank new ads post-Recon is likely due to a return to fundamentals coupled with increased active fund ownership and an abatement of Recon trading pressures. An unwind of short interest hedges and increased institutional ownership of Russell 2000 new ads helps buoy post-Recon performance. The average institutional ownership of Russell 2000 new ads rose to 65% by year-end and post-Recon from 47% at 3Q prior to Recon. As bank new ads stand out relative to the broader group post-Recon, investors should be aware that Recon will be occurring not once, but twice next year. In 2026, FTSE Russell will move from an annual June Recon to a biannual schedule, with Recons happening in both June and November. Recon is based upon the market capitalization ranking of eligible stocks on the rank days, which will now occur on the last trading day in April for the June Recon and on the last trading day in September for the November Recon. Recon will occur after the close on the last Friday in June and the second Friday in November. In summary, banking stock ads to the Russell 2000 outperform when other industry ads underperform because banks are highly regulated, thus somewhat more immune to failure risk. Banks therefore tend to benefit completely from increased institutional shareholder demand post-Reconstitution and a dedicated passive shareholder base. As always, it's a pleasure to share my insights with all of you. If you have any questions regarding today's topics and want to discuss it further with me, please reach out to your Stevens sales representative.